Hi students, this is AJ sir. Let's study 9th standard ICSE Math exercise 2B. Now in exercise 2B, cancel the first sum, it's very easy. Mark the third sum and the seventh sum as IMP. Now in the third sum, a sum of money is lent, so principal is not given, rate of interest is given. And if the interest for the second year exceeds that for the first year by rupees 96, that is CI2 minus CI1 is 96. Now we can solve this by the X method, but I would use the 100 method. That is, we'll assume the principal to be 100 first of all. So we'll deal with assumed values here. Get for the first year, get the compound interest 8. Find the amount because that will be the principal for the second year. Find the compound interest for the second year. Now find the difference between the compound interest of second year and the compound interest for first year, which is 0.64. And then use unitary method. When the assumed principal is 100, the assumed difference between the two compound interests is 0.64. But the actual difference is given as 96 rupees. So what is the actual principal? Cross multiply and get the answer as 15,000. Now in the fifth sum, the principal amount is given as 5,000. Rate is given. Now the compound interest is calculated after every 6 months. And he repays 1,800 after every 6 months. Calculate the third and final payment after 18 months, that's 1.5 years. So we'll have 3 parts for this sum. For the first 6-month period, principal is given, calculate the compound interest using the usual formula and get the amount. For the second 6-month period, the amount should be the principal. However, he made a payment of 1,800 towards his debt. So now his principal amount will be reduced by that same amount. So now he will have to pay interest only on the remaining 3,500 rupees, which comes up to 210 rupees. So the amount to be paid to clear his debt now is 3,710. Now at the beginning of the third 6-month period, he could not pay 3,710, he's paying only 1,800, so he still has to pay 1,910. So let's calculate the interest on this amount, which comes up to 114 rupees and 60 paise. So after the 18-month period, the final amount he has to pay to clear his debt entirely is this. Now in the 7th sum, a manufacturer estimates that his machine depreciates by 15%. There is a depreciation sum of its value at the beginning of the year. So the principal, that is the cost of the machine, is not given. Find the original value, that is the principal, if it depreciates by 5,355 during the second year. So this 5,355 is actually CI2 or compound interest for the second year. Actually it's the depreciation of the second year, but the formula will be similar. I say similar because after assuming the principal as 100 and calculating the compound interest as rupees 15, the amount after the first year, that is the cost of the machine, actually decreases because there's a depreciation here. This is the depreciated value after first year, which becomes the principal after the second year. So we find the compound interest for the second year. Now they have given that the depreciation of the second year, which I have written as CI, but you could very easily write it as DEP as well. So when the assumed principal, that is the cost of the machine, is 100, let me just mention that. Let this be depreciation. It's advisable to write this. The assumed depreciation for the second year is 12.75. When the actual depreciation is this much, what is the principal? Cross multiply, and in the final statement, please don't write principal, write cost of the machine is rupees 42,000. And don't write it on the last line of your page. You can go to the next page. Now in the ninth sum, a man saves rupees 3,000 every year and invests it at the end of the year. Notice it happens at the end of the year, perhaps on 31st December at 10% compound interest. Calculate the total amount of his savings at the end of the third year, that is on the first day of the fourth year. So for the first year there are no calculations because the whole year he didn't invest anything. He was busy saving, and only on the 31st December of the first year, if I'm assuming the year ending on 31st December for this calculation, then the second year's principal will now be the 3,000 rupees. So on the 1st January of the second year, the amount in his bank is 3,000 rupees. The whole year he will accumulate some interest on it, which is 300. At the end of the year, he sees it's 3,300. But on top of that, he adds 3,000 rupees further. So in the beginning of the third year, he will see that the total principal he has is 6,300. Throughout the third year, he will get interest on this amount. So at the end of the third year, he has rupees 6,930. But on the last day of the third year, again he had invested 3,000 rupees further. So at the end of the third year, he has totally rupees 9,930.